Good afternoon, everyone, and thank you so much for taking the time to join us for our Smart Women Savvy Money 2010 series. Our sessions are designed to run for a half an hour. We know that we have very, very busy members, so it's 20 minutes, 30 minutes on the clock, 20 minutes to teach, and 10 to talk. So hopefully we will have some time for some questions at the end of our program because this is a very hot topic. But before I get in today and introduce today's speaker, I did also want to make you aware of some of our upcoming events. For some of you who've never been on our calls before, just a little background. We have been hosting the Smart Women Savvy Money webinars for about the past 4 years. They're always complimentary, and they're held on the second Thursday of every month at 1 o'clock Pacific time. We do have people calling in from all over the country. So the great part is if you cannot make it for a live session, we always will send out the replay link as long as you register for the sessions. For the next few months, and we have everything listed on our website, so please do come to our website to see what the next set of webinars are. For next month, for example, we're going to have a great dietitian and nutritionist who will speak about ways to combat sugar addiction. For August, and this is going to be really, really relevant for us because as women, we're always multitasking and doing all kinds of activities. Her talk is going to be about how do you stay centered to be able to not have a drain on your life and stay strong mentally, physically, and emotionally as well. Also, in the month of September, and this might be relevant for you or family members, is how to take the mystery out of Medicare. If you are applying for Medicare and you've looked at all of the plans, and there are multitudes of them, it's very confusing. And so we have a fabulous team of women who actually do provide assistance not only for Medicare but all types of health insurance plans. Next, and this is going to be especially important since we live in such a digital world, how do you cover your digital assets? So we came up with that because most of us are online. If you certainly online, you're doing emails, you have Facebook pages. These are all digital assets, and even having access to your bank accounts. What happens if you are incapacitated or you pass away? So we have two wonderful attorneys on who are going to be speaking about that issue, estate planning attorneys. So you definitely want to be on that. And our last event of the year is Dr. Lois Franco, who is amazing. For any of you who came to our women's conference last January, Dr. Franco is very inspirational and is an author of many books, one of which probably a lot of people are aware of is Nice Girls Don't Get the Corner Office. So she's going to be our last and great speaker for the end of the year, and then we will be hosting and put up our schedule for the remaining for 2019. So with that said, I do want to move on to today's speaker. And really excited about having Bella Wang on because she is a person who I met several months ago and found out that we have mutual clients. She's extremely competent, and she looks like she's 20, but she's been in business for 20 years and is a CPA as well as a supervisor manager for Wines, which is located in various cities here in the Southern California area. So I think that you will be very, very happy to hear some of the content that she has to share with us today. We've had enough time, we think, to be able to understand what the new tax act has, what kind of impact it's had. But there were a lot of subtleties in there and nuances that, depending on the state that you live in, could have a major impact on your tax planning. So with that, I'm going to turn it over to Bella to get started.
Thank you, Renee. Good afternoon, everyone. I'm very excited to be your presenter today. Today we are going to talk about tax reform, how exciting taxes. I believe everybody loves taxes. By the way, I just want to remind everybody, if you have to make a quarterly estimate tax payment, tomorrow is your deadline. So you have to make your second quarter estimate by tomorrow, June 15th. So don't forget about that. So you don't want to end up paying the penalty. I have a lot of information to cover, so let's go ahead and get started. As you can see from my first slide, there's a slight changes to the tax rate and the bracket. So the maximum tax rate was reduced from 39.6% to 37%. Yay, good news for the high income taxpayers. Now they got a little 2.6% tax cut there. No change to the long-term capital gain and the qualified dividend tax rate. And also there's no change to the 3.8% net investment income tax or the 0.9% Medicare tax on the high wage earner. For people who don't claim itemized deductions, this is a good news for them. The standard deduction doubled from 2017 to 2018. So for single taxpayer, it's $12,000 going forward. For married file joint, it's $24,000 going forward, and head of household is $18,000. Unfortunately, the personal exemption, it was suspended through end of 2025. So if you have a dependent like child, and parents, in the past you get tax saving on claiming them as you're dependent on your tax return. Unfortunately, it's no longer available. Next is a summary of the changes to the itemized deductions, and I'm going to go over each item, each deduction individually in a little bit more detail. First is the medical expenses. So for 2017 and 2018 on your tax return, you can deduct your medical expenses that you pay in excess of 7.5% of your adjusted gross income. So for example, if your adjusted gross income is $100,000 and you pay $10,000 of medical expenses in 2018, since 7.5% of your adjusted gross income is $7,500, then your tax deduction will be $2,500. Keep in mind that the 7.5% threshold only applies to your 2017 and 2018 tax return. For 2019 and forward, you go back to 10%. So go back to that previous example. If you pay $10,000 medical expenses, if that was paid in 2019, then you won't get any tax deduction since that's 10% of your adjusted gross income. So one planning tip, if you had a surgery coming up, or you're going to have some significant amount of medical expenses that you have to pay, you may want to do that before end of the year to maximize the tax benefit you can get on the medical expenses. And I think the majority of the audience may be California residents, so when I go through those itemized deductions, I will quickly mention that whether California conform to the federal changes or not, and you can also see that on my slide. So for medical expenses, California still remain at 7.5% of adjusted gross income. Next is the big hot topic. It's a state and local tax deductions. As you may remember, last year, right before the year end, a lot of people are waiting in line, like they go to the LA County Assessor Office and try to prepay their property tax ahead of time before December 31st, 2017. And the reason is because in 2018 and forward, there's a $10,000 limit on your total tax deduction for your state and local tax, which include your income tax and the property tax you pay on your house and on your car. So California being one of the high tax states, everybody in California is affected by this rule. So, most people, just by looking at the income tax they pay to California, it's already exceed $10,000. So that means that going forward, you won't be able to get any tax benefit on the tax you pay on your home and also on your car. keep in mind that California has not conformed to that change. So on your California return, you can still deduct your property taxes. So next year when it's time to file your tax return, you still want to make sure that you forward that information to your tax return preparer so you can still deduct those expenses on your California return. Next is also a hot topic. You probably hear a lot of discussion about this change on the social media or on the internet. So this is regarding the home mortgage interest deduction. Before the law change, as long as your mortgage balance does not exceed 1.1 million, then you can deduct the whole interest that you pay on your home mortgage. After the tax reform, now the limit is reduced to $750,000. So the new limit applied to the loan you took out after December 15, 2017. So if you have an old loan, the new limit does not apply. So in California, it will be very easy to reach that limit because just think about if you purchase a house for $850,000 and if you put 10% down, then your balance, your mortgage balance will be over $750,000. So many people are speculating that this new tax law change will affect the real estate market in California. So it'd be interesting to see what's going to happen to the real estate in the next couple of years. The other big change is that if you have a home equity line, the interest you pay on your home equity line is no longer tax deductible. And this does not apply to just a new loan. It also applies to any equity line you took out before December 15, 2017. However, there's one exception. If the loan proceeds is used to do some home improvement or is part of you use the money to purchase the house, then you can still deduct the interest on the equity line. So it's very important to keep in mind that when you take out the home equity line or try to go back and find the original documentation to make sure that you can prove that you do use the proceeds for home improvement or for original purchase, just in case if you get audited by the IRS. Another point on the mortgage interest is that the mortgage interest you pay on the second home is still tax deductible as long as the mortgage balance is below the limit. And there's another change is the mortgage insurance premium. Originally, this tax deduction is expired at end of 2016, and it was extended in February 2018. So a lot of people, if you file your 2017 tax return too early, like in early February or end of January before the extender bill got passed, then you may want to consider go back and amend your return if you didn't claim that deduction for the mortgage insurance premium you paid. And at this point, there's no change to the California rule yet. So on your California return, you can still deduct the whole mortgage interest as long as the balance is under 1.1 million. Charitable contributions, there's just a small change, and actually this is in the taxpayer benefit favor, is that they increase the adjusted gross income from 50% to 60%. So in the past, you can only deduct charitable contribution up to 50% of your adjusted gross income. Now you can deduct up to 60% of your adjusted gross income. And no change to California rule, so it's still limited to 50% of your adjusted gross income. Casualty loss, unfortunately, you can no longer deduct casualty loss on your federal return. If you have losses from water damage or somebody breaking into your house, steal your jewelry, in the past you can deduct those losses on your federal return. Is no longer available. But California is still available. You can still deduct those losses on your California returns. The other big change is that miscellaneous itemized deduction are no longer available. So in the past, you can claim your miscellaneous, you can deduct your miscellaneous itemized deduction, and the true tax deduction is the amount that's over 2% of your adjusted gross income. So it's similar to the medical expenses. Let's say your adjusted gross income is $100,000. You aggregate all your miscellaneous itemized deduction, and you get a deduct total that's over 2% of your adjusted gross income. But after January 1st, 2018, this is no longer available. What's included in the miscellaneous itemized deduction are reimbursed employee business expenses, the tax return preparation fee, so the fee you pay to your accountant to prepare your return, those are no longer deductible, and also the fee you pay to your financial advisor, those are also no longer deductible. However, you can still deduct those expenses on your California return, so you still want to make sure that you have all the information gather, compile, and then give to your tax return preparer, because you can still get a benefit on your California returns. One last thing on the itemized deduction is the 3% adjusted gross income phase out. So before, there's a limit on the total amount you can deduct on your itemized deduction, but that phase out is suspended through December 31st, 2025. So if you are a high income taxpayer, this will benefit you. The other two items is the moving expenses. So if you relocate because you change job, before you can deduct those expenses on your federal return, it's no longer deductible. It's suspended through end of 2025. And if your employer reimburse you for those relocation expenses, now they have to include the reimbursement on your W-2 as a taxable fringe benefit. The other big change is the alimony payment. So if you finalize your divorce agreement after this year, December 31st, 2018, the payer, whoever paid the alimony, can no longer deduct the payment on their return. And on the other hand, the person who receives the alimony don't have to include the amount they receive on their tax return as income. And no change to California, so even for the divorce that's finalized after this year, the payer can still deduct the payment on their return, and the recipient still need to include them as income. For families that have a child, this is a good news. The child tax credit increased to $2,000 per child, and $1,400 is refundable. So let's say you didn't really pay much tax this year because income is low, and you not only claim the $2,000 credit per child, but $1,400 is actually money coming back to you. And also because they take away the personal exemption for the dependent, now they allow you to claim $500 tax credit for each dependent that you claim on your tax return. It's called family tax credit. And this applies to children who are over 17 years old because they don't qualify for the child tax credit, and also apply to parents and anyone else that you claim is dependent on your tax return. Keep in mind, for a child tax credit, if you want to claim that on the return, you need to provide the Social Security number on your tax return. Otherwise, the IRS will disallow it. But for the family tax credit, the $500 credit, no Social Security number is required. And for the kiddie tax, there's some change to the kiddie tax. So the kiddie tax applies to child who has investment income or earned income and who has to file their own separate return. In the past, if the child filed their own separate return and their income is taxed at the parent tax rate. So if the parents are at the highest tax bracket, then the kids can end up paying the maximum tax based on the high tax rate. But now this changed, so for 2018 and forward, for the kids that have unearned income and have to file their separate return, their income will be taxed at the trust rate. The other big change is the 529 plan. So for before the law change, you can only take money out of your 529 account for college, and now it's available for elementary and high school tuition. However, it's limited to $10,000 per year. You can only take out $10,000 per year out of your 529 account for the elementary and high school. And keep in mind, California does not conform to the change. So if you decide to take the money out of your 529 plan and for the elementary and high school, you will need to figure out how much of the distribution is the taxable earning, and you will have to pay California income tax on the taxable portion plus 2.5% penalty on that portion. So you got to think about before you decide to do that. Another big change is the individual mandate for the health insurance coverage is repealed. So starting 2018, individual is not required to get health insurance coverage going forward. And also there's a couple changes to the retirement account. First is if you want to convert your traditional IRA to Roth IRA, under the old rule, if you change your mind, you can move the money from the Roth IRA back to the traditional IRA within 60 days. However, it's no longer available. If you convert your traditional IRA to Roth IRA, you're stuck with it. You cannot go back. You cannot change that conversion. The other big change is the outstanding 401k loan. If you have an outstanding loan with your 401k and you separate from your employer, under the old rule, you only have 60 days to pay back the loan. If you don't pay back the loan within the 60 days, the loan will be considered as a distribution to you, and you will have to pay income tax on the loan amount plus the 10% early withdrawal penalty if you didn't reach 59 and a half. But that rule got changed. Now they were saying that if you file an extension, you will have until the extended due date to pay back the outstanding 401k loan. So since we are in the 2018, for example, if you have outstanding loan against your 401k account in 2017 and you separate from your employer, you terminate your employment contract with your employer in 2017, and in 2018 you file a valid extension, you will have until October 15, 2018 to pay back that loan, and then you don't have to pick up as income. One change on the annual gift tax exclusion is that now you can give $15,000 to each person. So for married couple, husband can give $15,000 to one kid, and wife can give $15,000 to that same kid. So just a few planning tips for you to take away. First, you want to make sure that you check your income tax withholding on your paycheck, because the tax rate change and the changes in your standard deduction or itemized deduction, you want to make sure that you have enough withholding to cover your 2018 tax liability, so you don't end up with a big surprise next year in April when you're ready to file your taxes. And you also don't want to withhold too much, because if you withhold too much, then that means you just give government free money and they don't pay you any interest on that. So you really want to have more. You want to have more money, more cash in your pocket, and then give it to your financial advisor, and they will invest the money wisely for you. Yeah, that's a better use of your money. The second tip is you want to consider bundle your itemized deduction, such as your charitable contribution or your medical expenses. So for your charitable contribution, for example, you always give $10,000 to your church every year. So if let's say the $10,000 donation is the only deduction you can claim on your return, if you do nothing, then the $10,000 is going to now be under the standard deduction. So that means you will just be claiming claiming standard deduction, you won't get any tax benefit on the $10,000 you donate to your church. But let's say if you decide just to bundle it, like do all, like let's say you're just going to donate $50,000 in 1 year, so then you get a maximum deduction of on that $50,000 in the year you donated, and the rest of the year then you can just claim the standard deduction. Then you really maxed out your benefit on those deductions. Third bullet point is because we have very limited time, so I didn't really go into the new deduction on the business income for business owners, but this is something you can consider if you own a business and you want to get maximum tax benefit on this new 198 deduction, then this is something you can consider doing. And then you also want to review your estate plan because the tax reform increase the lifetime exclusion for gift tax, estate tax from $5 million to $10 million per person. So now is the perfect timing to look at your estate plan. You want to make sure that you take the maximum benefit of that increase in the lifetime exemption. Then lastly, you want to review your investment portfolio with your financial advisor, and don't wait. Talk to your CPA, talk to your financial advisor now, and try to figure out what you should do now to get ready for this big tax reform. With that, I think I conclude my presentation, and I have a slide here with my contact information. Please feel free to call me or email me if you have any questions. I'm always here to help.
Awesome. Thank you so much, Bella. And that was amazing. And for many of you on the call, I just want to share with you that Bella had put together an amazing presentation, but because of the short time that we had, we didn't have time to go through it all. So we're going to provide you with a link to take you to the full presentation, which has a whole segment on business and business owners. This new tax act is really benefiting business owners from the standpoint of multiple deductions and the ability to write off things on a permanent basis versus individual tax deductions, which, as she's pointed out, is only good until 2025. So there's a lot of incentive if you are a sole proprietor, you're a contractor, to consider making and creating a business entity. So the link will take you directly to the Wang's site. You'll have to put in your name, your contact information, and then it will open up and you'll be able to see the entire presentation. So with that, Bella, I want to thank you so much for taking time out of your really busy day, because June 15th is tomorrow, and I'm sure you're going to have to ping a lot of people to tell them to make sure that they're paying their quarterly taxes on time. So we'll also make sure that everyone has her contact information as well, and as she indicated, and I think this is very true for everyone, with this new tax law, you really do need to do some tax planning. Just not do tax preparation, but work with a tax advisor, professional, a CPA, and do that early on, because as she indicated, towards the end of this year and certainly as you go into 2019, it's going to be too late. So with that, thank you so much, Bella. Have a wonderful day, and we look forward to working with you in the future.
Thank you.